Hello everyone, welcome to IGCSE Accounting. Today this video is covering about accounting overview. Okay, let's start with our agenda for today. First of all, I would like to introduce you why people doing business and what is the purpose of having accounting. The difference between bookkeeping and also accounting. There are people that confused about this too. So in this course, we will look into it. And the later part, we will talk about the measurement of the profit and loss and also the important account equation, which is asset, liabilities, and also owner equity. Okay, let's start with the business objective. People running business for many different reasons. Number one, they are looking at that they can grow the business so big until they can conquer the world. Okay, so there are people in this objective. Some people they not so much in terms of in the initial profits and earning money. They want to have the market share first. That means they want to make everyone using or buying the product first, with maybe with a minimum income revenue, but the objective is to get the market share. Once they get market share, maybe they are looking at exit. That means sell off the business in order to make even more money. Maybe there are various type of business model. Okay, another possibility is for survival, just want to sustain the business. And they are people that are running the business because just want to break even. Break even means that your expenses and income is the same. That means no profit, no loss. Okay, just equal. All right, that is what here means break even. And there are people that is not so much in terms of making a lot of money, but they want to do the business in order to sustain and serve the society for community purpose. All right. There are business like the social enterprise. They maybe, for example, for education purpose, there are business that they just want to helping out the many communities and one that is with some of the objective that possible. Lastly is maybe because of environmental. They run this business, open this business is just to make sure that the environment is protected and then make some money and in order to sustain it. So there is many different possibility. Please bear in mind that this is some of the example you have to remember so that maybe your IGCSE exam paper will come out. So roughly you need to remember a few of them. All right, now come to the very important definition, which is accounting. Make sure you really remember this. Okay, the process of recording financial transaction, producing financial statement, and analyzing the financial performance of a business. All right. So actually, in this statement, you can see that it's three different steps. Allow me, I just before this, I already prepared it. So, okay. Inside the accounting box, step number one, financial transaction. That means it's all about the transaction that you want to keep it, to record it. All right. And it actually means step one, which is about financial transaction. So you have all the transaction. For example, you pay the toll, you get the receipt. And then you take the receipt, you go back to your company and tell your account bookkeeper saying that please record this into our account. All right. And maybe you buy something, you buy a radio for the business. I have to emphasize for the business, not for your own self. All right. And then this radio actually belong to the business. All right. So the receipt of it, of the you pay for it, okay, that receipt actually means a lot to the business, means a lot to the accounting. That is what we call transaction. Okay. And all have to be recorded. So it's step one, transaction, financial transaction. Okay, the step two, according to all the transaction, you produce the financial statements. Okay, let me do some. improvement of this. So after you record everything, so you produce the financial statements. Okay, so after you record everything and then you produce the financial statements, right? Produce the financial statement is imagine that it's a report. Later part we will go into what is financial statement. They are too important below. Later I will talk about it. All right. And then after you produce the statements, in this stage, normally is the time that you have to analyze it. Okay. All right. But actually, is the step 3 is analyze it. What you analyze? Analyze the financial statement. So that is the case. All right. So you need to know these 3 steps. What is the relationship? Okay. In the later part, we will talk about other boxes. All right. This is the. I repeat one more time. This is the 3 steps for accounting that you need to remember. All right. Okay. Now, what is the definition of the bookkeeping? All right. The definition is the process of recording the financial transaction of a business. For your personal, not count, all right? Not count, okay. So, as you can see here, actually bookkeeping is the financial transaction. It actually happened inside this box. So, bookkeeping is inside the accounting box. Okay, I hope I make this very, very clear to you. All right. Now, next slide. Okay, so in bookkeeping, first step, you have to record all the transactions. And there are some terms and some studies will say that actually the step one, the step one, instead of recording it, is to identify it. Yes, that is correct. Because once you got all the receipts for all the business documents like invoice, delivery note, etc., you need to identify that which one you have to record, which one you no need to record, and those that you need to record, you have to put into which account. All right. So that is the part. The step one is to identify is correct, but in the just now we talk about the definition. It didn't say the identify the transaction. Don't worry about it. You know that will do. All right. Okay. And then now you record it. And the way how you record it is double entry. It means in the later part of this course, you keep listen and hear from me that double entry. What is double entry? Later I will explain further. But I just want to tell you, double entry is a method, is a way to do it. All right. And double entry, one side debit, one side credit. Later I will teach you how to remember that. Okay. Then the next thing is I want to talk about is when I say double entry, okay, and then that is the way how to do it, but do at where? Okay, do at journal and ledger. This is where it coming from. Journal and ledger is where you performing your double entry. All right. Then the last step is after you do all these things, the final step is to double check all the we keep saying the terms reconciliation, which is to double check all the transaction. For example, your bank statement will come to you, the bank will send it to you for you to double confirm whether it match with your records or the transaction. So to double check, for example, sometimes some business they will ask their supplier or maybe even their vendor to provide them a statement of account, which is a document in order to double confirm whether all the records is correct or not, all the in out. Okay, so that is where it coming from. Okay, so now let's come to the next slide. Financial statement, right? The definition of financial statement is a statement produced for an accounting period. All right, later I will talk about accounting period, summarizing the business performance, and it actually includes 2 important documents, which is income statement and also the statement of financial position. All right, these 2 is super important, but over here just to let you know that in year 2001 and before, that means before year 2001, income statement actually named as profit and loss. Okay, and also statement of financial position used to name as balance sheet. So in future, if let's say you heard someone mention about balance sheet, then you know it's statement of financial position. But now, because you are now in 2025, right? So no more balance sheet. You need to know the name of that statement is statement of financial position. I hope you can remember that. All right. So let's go back to the chart that just now. Now we want to look at these two things, which is in terms of producing the financial statement, there are two of them, two important of them. One is income statement. Okay, the other one is statement of financial position. Okay, so you need to remember these two. Producing financial statement, there are two important statements. One is income statement, the other one is statement of financial position. All right. Okay, let's continue. Oops. Okay, yeah, profit and loss. As I mentioned just now, majority of the business is for profit. They want to make money, right? When your income more than the expenses equivalent of profit. For example, you buy a pair of shoes. You buy the shoes, you pay, let's say, 20 ringgit. That is your expenses. You buying the cost of the goods, which is the shoes. And then you sell it off, let's say 50 ringgit, which is income. You get the money in, all right? So when the money is the income money, that means the price that you sold is 50, is more than expenses, which is only 20, the cost of it, there is an equivalent of profit of 30 ringgit. So that is what it means. When the time that what you spend is more than your income, for example, just now the shoes example, you bought it for 20 ringgit. But when you want to buy the shoes, you take a Grab, okay, to collect the shoes. The Grab costs you 40 ringgit. So shoes 20 ringgit plus your Grab, which is 40 ringgit, 60 ringgit. So 60 ringgit is more than how much you sold the product, which is the shoes, which is only 50 ringgit. So you are making a loss of 10 ringgit. That is a loss. Okay, so this is where the definition of profit and loss. And these things, everything, this important information, it actually shows in the income statement, which is ta-da, this one. So you can find the profit and or loss in the business. Okay, it's or, not and. It's no longer the X generation. All right. So the profit and or loss of the business you can find inside the income statement. Remember that. Okay. I hope you can remember this. Now, another thing that I have to emphasize here is accounting period is actually normally is 1 whole year. All right. But it doesn't mean that have to be 1st of January of the year and then you end the financial period for 31st of December. Not like that. You can start the business in 1st of, let's say, March. And then your business will end the following year, maybe it's 29th of February or 28th of February. So that is what it means. So the authority don't force you to start your business 1st of January. No such thing, okay? So you have to remember this. Okay, now you will be wondering what is the purpose of doing all this accounting? Is for who? Now we come to who, all right? We are preparing all this accounting process or all this tedious job for who? Okay, let's have a look. Number one, investor. All right. Why investor want to look at your account? Because they want to know that this business is profitable or not. If not, they don't want to invest. If let's say it looks good, there is a great potential to make a lot of profit, then they will invest into it or expecting the return on the investment we call ROI. All right. The second person that would love to have a look of all your financial statements is the lender normally. is bank. Okay, normally there are some financial institute also loan, to borrow money to the business. Okay, if the reason why they want to look at your account is because they want to check whether you can pay later. I borrow you the money. If you don't pay, then how? So they want to make sure. All right. Then the third person would like to know about this account financial statement is the management, the top management of the business, because they need to know, then they know what happened in the business, what happened in the operational side, and also to decide how to strategize in the future. Lastly is the government, which is the tax authority. If let's say you are making a profit, maybe they want to tax you. So in Malaysia, it's called LHDN. They are the one want to look at your financial statement and then to check that whether you profit or not. If not, that's fine. But if yes, yeah, that is the time they come to you and ask you to pay tax. So paying tax is important and responsibility for all the entity, including personal and also commercial, like a business. Okay, so this is where it's coming from. So in the just now the floor, oops, oh, it become double. All right. So this is who they are to look into here. So I put some color to make it more interesting. Okay, this is who they are. Want to know. Normally, only management analyzing it. The rest of it normally only look at the financial statement, and they will know something what happened. Of course, the investor they will analyze even more. Okay, now next thing, the purpose of accounting. So this is just a summary of what I just now brief you. Record of financial transaction, record everything, including the payroll, and then to make sure that there is a transparency of records with a proof. Remember, proof. Okay, that's why you can see that most of the time we are keeping a lot of receipts, records. Nowadays, a lot of it is in soft copy, like e-invoice that we recently heard a lot, and information of to the stakeholders. So once we record, and then the bank, the authority will want to know, and for what? For them to do decision whether they want to hire more, whether they want to they want to put more money into R&D to expand more, and marketing also possible because they see the potential of the business. Lastly, the legality and the regulation. Okay, so in this course, I will repeat a lot and you will hear me a lot about debit and credits, and also asset, liability, and equity. Okay, asset is the items that belong to the business. The liability is obligation of the business owns back to the others. For example, you buy something. And then you are taking you are not paying it directly with a credit to someone else, another business maybe, and then that is considered a loan. All right, and it will become a liability to your business. Okay, this is the example. Or another example is like you loan from the bank, and then there is a loan, also a liability. And lastly, equity is the share. That means the money that the owner put into the business is called owner's equity, right? It's just like a share to the business. Okay, and then you maybe heard some terms of management accounting, using the financial information to make business decision concerning about the cost, the revenue, and also the output. Okay, now I do some comparison between management accounting and accounting. It's different thing, all right? First thing is different is management accounting is for internal purpose. It's not so much towards the stakeholders that just now I mentioned beside the management, all right? So it's for internal, which is for the boss, for the top management. For what purpose? For decision making. Okay, they want to do management accounting because they want to make some decision, do some strategy, do some budget forecasting and cost analysis. So that's why they do management accounting. All right, and then just let you know that previously I mentioned accounting is one whole year, remember? And then the one whole year will not be the 1st of January until 31st. It can be any point of time of the year. Okay, Okay, but management accounting is not. Management accounting no need to be one whole year. It can be just a particular project, and the project, let's say, lasts for 2 months. It only for 2 months purpose, and then done. Project done. I mean, the accounting, this set of project is done. Management accounting done. Okay, and it's not mandatory. Majority of the business, like the SME, small and medium enterprise, they don't do management accounting a lot. All right, and then another big difference compare management accounting and accounting is, remember just now I keep saying that accounting need proof, need all the transaction, remember? But for management accounting, it can, you no need to, the transaction or the events of it, it might not be quantitative. All right, it can be qualitative. For example, how happy your customer is. Okay, you can record down how they feel. Okay, you can do a survey and then collect all the data, and all these things is considered management accounting. So this is something that you might want to exam maybe will have, so you at least you know what it looks like. And just let you know, management accounting is outside the box, it's not inside the box. Okay, I'll put another color. It's outside. Okay, all right, let's go continue. Okay. Just to say that some business, they do some budgeting. Why have to do budget? Because you cannot run the business without knowing that what you potentially have to pay maybe, and what potentially how much cash you need to be in hand in order to sustain it, right? So to manage the cash flow, which is this one, and also for planning purpose, for like financial goal, how much money next year you want to make. Okay, set a budget. Maybe you want to make this so much money, then you have to allocate certain fund to do marketing, so that a lot of people know about your brand in order for you to achieve the sales. Okay, so there is all these strategy have to play. All right, the usage of the profit. Okay, for business expansion, you maybe want to buy one more shop, go to another state to open another outlet, etc. For research and development, we call R&D. All right, to come up with a new product, new piece of software, maybe paying off the debt. That means you make profit already, but you owe so much money to the bank, and you don't want to pay the interest anymore, so you want to clear off some of the loan maybe. And they ask business also reserve for emergency. For example, who knows, COVID. Of course everyone don't want it, but you maybe need to reserve certain fund in order to, for any unforeseen circumstances. All right, and so yeah, this is where I tell you later. I will keep mention about debit and credit. All right, this is also what we call double entry. You need to know that in account bookkeeping, you keep hearing double entry, because this is to ensure that everything is correct. That is the accuracy part. Right. Okay. Statement of financial position, which is used to name as balance sheet last time. What is the definition? A financial statement showing the asset of the business and also the financing of the asset. How you get the asset, which is either from the owner equity, that means the owner put in the money, or liability, maybe you loan from somebody. Okay, so that is where the financial position about. And this statement, it looks like this. A in the left, which is asset, resource used within the business for its activities. And in right, owner's equity on the top, business resources supplied by the owner of the business, and the liability at the bottom. Liability amounts that borrowed to fund the business activity. Okay, so this thing is so critical that you really, really have to remember. A in left, E and L in right. So I also put into the overview chart here. Here you go. Yeah, so this is the thing that I hope you can remember this. I put some nice color to it. Okay, so yeah, I realized I didn't put any color for this. So I put Maybe. Ooh, sorry. Maybe not. Okay. So let's see what else I not yet cover. Yeah, here you go. So this formula you have to remember. Asset equals to liability plus owner equity. Okay, if let's say you or the other way around, which is maybe owner equity equals to asset minus liability. Yeah, something like that. Okay, so in the next video I will talk about some example for statement of financial position. So yeah, looking forward to the next video. Thank you very much.